This is an emergency broadcast, and before we even pretend the charts matter, I need you to do one simple thing. Go to your wallet, pull out a $1 bill, hold it up under a light, look at George Washington's face like it's a mirror, study the eyes, study the mouth. Ask yourself a question you've been trained not to ask. Does he look proud of what we've turned his legacy into? Or does he look like a man watching his name get stamped onto paper that buys less every week? If you still believe that green rectangle is money, you're about to get a lesson in physics, and physics doesn't negotiate. Put down the remote. The cat videos will survive. The only thing that won't survive is complacency, because complacency is how you get robbed without noticing. The financial system is not fine, and the sooner you stop treating this like background noise, the less it's going to hurt. We have crossed a line that economists will argue about for decades, but historians will describe in one word: war. The kind that happens behind numbers, through supply chains, through freight schedules, through vault doors and settlement clauses. The battlefield is no longer theoretical. It's arithmetic, it's delivery, it's inventory. And today you're staring at a split reality that shouldn't exist in a world that claims markets are efficient and connected. In a normal world, the price of the same asset doesn't live in two universes at once. You can buy an iPhone in New York and in London, and after you adjust for taxes, exchange rates, and shipping, the price converges. A barrel of oil doesn't trade for one number in Texas and a completely different number in Tokyo for long, because the spread invites predators, arbitrageurs. They step in, buy where it's cheap, sell where it's expensive, and they crush the gap until the numbers line up. That's how the system stays stitched together. That's how you know the machine is working. And yes, there are always reasons prices can differ for a while. Taxes, import duties, different bar specifications, settlement calendars, financing costs, shipping insurance, or simply the fact that a truck can't teleport. Those frictions create small, explainable spreads that fade as metal moves and profits get harvested. What you are seeing now is not friction. It is a rupture. A gap so wide it tells you the usual plumbing is clogged, delivery is being rationed, and confidence in the official quote has started to leak out of the pipes. But today, the stitches are ripping. Today, the laws of economics are being bent by the laws of power. The price of silver, real silver, the element on the periodic table, the metal used to conduct electricity and reflect light and make modern technology possible, has fractured into two incompatible prices. Like reality itself has split. On one side, you have New York, the paper casino, the synthetic arena where banks and funds throw contracts at each other the way gamblers throw chips. On your screen, it looks like silver has been crushed. It's hovering around $16 and change. If you're a Western investor who only knows the price that flashes on financial TV, you're being coached to panic. You're being invited to believe the rally is over, that the bubble popped, that the smart money won, and you were the fool. Now jump 7,000 miles east. Look at the price where delivery matters, where metal is demanded by factories and not just by traders. Look at Shanghai. Look at the market where people actually need the stuff to build solar panels, electronics, industrial components, and yes, weapons. Over there, the number is not 16, it's over 120. And the difference between those two numbers isn't a cute regional premium. It's a siren. It's an alarm so loud your ears should ring. Do the math slowly, because this is where the story stops being opinion and starts being mechanics. 16 versus 126 is not a rounding error. It's not a temporary glitch. It's a gap that any sane system would instantly close, unless something is blocking it. Unless the price in one place isn't a price at all, but a policy tool, a psychological weapon, a narrative management trick. In arbitrage land, a 1% spread is lunch money. A few percent is a career. 20% is a supernova. 20% is a black hole that drags real goods through space like gravity. A spread like that doesn't just invite traders. It commands the physical supply chain to move. It reorders shipping routes. It changes where refineries allocate output. It tells vaults which doors to open and which to weld shut. Picture a refiner in Switzerland or a wholesaler in London. 1,000-ounce bar sits on the desk. Real weight, real atoms, real scarcity. 2 phone lines ring. On line 1 is a banker in New York offering the paper price, the televised price, the official price. On line 2 is a buyer in Shanghai offering a premium that makes the first offer look like a prank. You do not need a PhD to predict what happens. You sell to the highest bidder. You sell to the place where metal is valued as metal, not as a spreadsheet cell. That is the mechanism of the pull. That spread is a vacuum. It guarantees that metal flows out of Western vaults and into Eastern hands. It's not about ideology, it's about incentives. The highest price wins. And right now, the highest price is screaming from the East. If you want to understand why this feels like war, understand what happens next. Vaults in London, New York, and Toronto can report eligible inventory all day long. But eligible is not the same as available. Registered inventory can look healthy until delivery demand spikes. You can't build solar panels with Excel spreadsheets. You can't wire a missile with a futures contract. The physical world demands atoms, not promises. So when that gap widens, the West starts bleeding real metal. Every day the spread stays open is another day the supply chain has a reason to choose Shanghai over New York. And the terrifying part is this: the people who run the paper market can celebrate a falling screen price as a victory, but all they're really doing is holding a clearance sale while the warehouse burns down. They can smash the quote lower, and they can cheer, and they can tweet, and they can run victory laps on television. Meanwhile, the inventory is walking out the back door in forklifts. And here's where the story stops being a quirky commodity tale and becomes a currency tale. Because this dislocation doesn't happen in a vacuum. It detonates when the denominator, the thing you use to measure everything, starts to break. The disease is the currency. The arbitrage blast is the symptom. We need to talk about the dollar index, the DXY, because you cannot understand why silver is ripping the system apart until you understand why the dollar is losing its grip on reality. For nearly a century, the dollar has been the ruler used to measure global value. It's been the default unit, the thing governments held as reserves and corporations used for settlement, and investors treated as safe. But now, the ruler is shrinking in your hand. The chart you've been trained to worship is flashing a warning. The DXY broke below a critical level that traders treat like bedrock, that policymakers watch like a heartbeat. When it slides under that kind of support, it's not a normal dip. It's a structural crack. It signals that the reserve currency is losing altitude. And when the reserve currency loses altitude, everything priced in that currency starts to float higher, not because the asset got better, but because the measuring stick got worse. Look at it year over year, and the damage becomes obvious. When the dollar is down around 10% against a basket of foreign currencies, that means holding cash was not safe. It was a quiet loss. You didn't have to spend a dime to get poorer. You simply had to sit still while the denominator evaporated. That is erosion that feels like normal life until you calculate it. To see the real fracture, don't stare at one index. Look at the real money pairs. Watch what happens against currencies with reputations for discipline, like the Swiss franc. Watch what happens against the euro. When the dollar slides that hard against multiple counterparts, it's not a rumor, it's a vote. It's the world repricing the U.S. promise. And here's the nightmare loop. Central banks, sovereign wealth funds, and large pools of capital don't dump the dollar because they're bored. They dump it when they suspect the system that backs it is trapped. They dump it when debt levels grow faster than productive capacity. They dump it when they sense that policy options are shrinking. The Federal Reserve sits in a trap with jaws on both sides. If it raises rates to defend the dollar, it risks detonating the debt-soaked economy. If it cuts rates to keep the economy breathing, it risks accelerating the dollar's decline. That's the math of too much leverage and too many promises. And when you reach that point, countries that don't want to be collateral damage begin to reposition. This is the part where people say, but the stock market is at all-time highs. Doesn't that mean everything is fine? No. Sometimes all-time highs are just a mirage caused by currency weakness. A market can go vertical in nominal terms while people get poorer in real terms. History isn't subtle about this. In places where currencies collapse, stock indexes can soar like rockets. Charts look incredible. Headlines celebrate record highs. Meanwhile, the population is crushed because the currency is dying and the numbers are lying. So if you're staring at new highs in the S&P and feeling reassured, ask a more brutal question. Is it the asset rising, or is it the dollar falling? If your house price doubles but your currency loses half its purchasing power, did you get wealthier, or did you just keep pace with a sinking ship? This is the trick that makes people feel rich while they tread water. Now put the pieces together. A weakening dollar makes commodities look volatile. A weakening dollar makes it easier for foreign buyers to scoop up real assets. A weakening dollar turns U.S. inventory into a discount rack for anyone holding stronger purchasing power. And when the dollar breaks key levels, it sends a signal. The time to convert paper claims into physical claims is now. For a country that thinks in decades, not quarters, that is an invitation. This is why the spread in silver matters. It's not just traders fighting. It's a battle over pricing power itself. Whoever controls the physical flow controls the reference price. Whoever has the metal sets the terms. If New York's price is a paper number and Shanghai's price is a delivery number, the world will eventually stop respecting the paper number. That is how empires lose financial influence, not with one explosion, but with a slow migration of trust. And that migration is happening through something that looks simple: premiums. The East is paying up. The West is suppressing. The gap is the pipeline, and the pipeline points one direction. Imagine the strategic logic from Beijing's viewpoint, stripped of slogans and emotion. On one side, they hold a mountain of U.S. Treasury bonds, paper claims on a future that is being diluted by debt and policy. On the other side, they have industrial demand, manufacturing, infrastructure, and a national security incentive to stockpile key inputs. If you believe the dollar is losing purchasing power, holding treasuries becomes a melting ice cube. So you don't sit there politely while the cube melts. You trade it for something that doesn't evaporate. How do you trade paper for atoms at scale? You create a market where the incentive is irresistible. You allow a premium to exist that pulls metal toward you like gravity. You let the West do its own sabotage by smashing the paper, quote, lower in an attempt to hide inflation. You turn your economy into a global magnet by being the highest bidder. Then you let capitalism do the dirty work. You don't have to threaten anyone. You don't need speeches. You just set the bid, and the supply chain obeys. This is why calling it a glitch is delusional. A spread like this is a weapon system. It doesn't fire bullets. It fires incentives. It doesn't leave craters. It leaves empty vaults. It doesn't require declaration. It functions automatically, hour by hour, shipment by shipment. Now, the defenders of the paper system aren't blind. They can see metal leaving. They can see delivery pressure. They can see the optics of a shortage while the screen price says cheap. And when you are losing a war you don't want to admit exists, you do what institutions always do. You change the rules. This is where the story gets ugly. Because if you can't find more supply and you can't stop the premium abroad, you try to crush demand at home by force. You don't win by producing more. You win by making participation too expensive. Enter the margin hike. This is the blunt instrument. This is the exchange pointing a financial gun at the head of anyone who dares to be long. If you've never traded futures, here's the simple explanation. A silver futures contract represents a large amount of metal, and traders don't have to pay the full value up front. They post margin, a performance bond, a down payment that allows leverage. It makes the market liquid. It's also the pressure point the exchange can squeeze when it wants to force certain behavior. When the exchange hikes the required margin dramatically, especially without warning, it can trigger forced liquidation. Traders who were positioned correctly can be wiped out, not because they were wrong, but because they can't meet the sudden cash demand. It's like changing the entry fee to a poker table after the cards are already dealt, and then announcing that anyone who can't pay immediately forfeits their hand. When you jack the maintenance margin for silver to something like $51,000 per contract, you are not managing risk. Instead, you are selecting winners by capital size. You're telling smaller players, leveraged funds, and speculative longs, get out now, regardless of your thesis. And when many people are forced to sell at the same time, the paper price collapses. Not because demand vanished, not because supply improved, because the structure was engineered to create a liquidation wave. This is why you can see a screen price smash down while the physical market feels tighter than ever. The futures, quote, can be bullied. Physical delivery cannot be bullied. You can terrorize traders with margin calls. You cannot margin call an industrial buyer who pays cash and needs metal for production. And that's the fatal flaw in the price smash strategy. It mostly hurts Western speculators. The big buyers in Asia don't operate with the same leverage. Industrial demand doesn't care about your paper volatility. They aren't buying to flip contracts next week. They're buying to keep factories running. If their economy needs silver, they pay for it. If they have a premium to pay, they pay it. If the West offers a discount because it's playing games, they smile and buy more. Your manipulation becomes their coupon. So the margin hike, intended as a defense, can become gasoline on the fire. It can make the U.S. paper price even cheaper relative to Shanghai, widening the incentive to drain inventory. It can accelerate the very outflow it was meant to slow. This is what desperation looks like, burning the market's liquidity to survive one more day of optics. But wars are not fought only with rules. They are fought with stories. When you can't change the physical facts, you try to change the public's perception of them. You try to kill demand by convincing people the thing they want is stupid, risky, illiquid, outdated. You don't have to win the argument forever. You just have to win long enough to survive the next settlement cycle. That's why, when the pressure rises, you see a strange phenomenon. Suddenly everyone who ignored silver for years becomes an expert explaining why it's a bad investment. The headlines get coordinated. The talking points appear as if written from one template. You hear the same phrases repeated: liquidity trap, hard to sell, barbarous relic, retail mania, pet rock. It's not that criticism is never valid. It's that the timing is always convenient. Here's the rule for surviving an information battlefield. Ignore the suit selling paper. Listen to the worker handling metal. Ignore the pundit paid to manufacture sentiment. Listen to someone downstream in the real economy who can't fake supply. In precious metals, that means refiners, mints, wholesalers, and fabricators. These people don't talk in metaphors. They talk in backlog, lead time, and capacity constraints. When refiners say demand is unprecedented, that matters more than a headline. When mints say they're running shifts around the clock, that matters more than a television segment. When wholesalers say delivery is delayed and premiums are rising, that matters more than a chart on your phone. And here's the part that should make your stomach drop. When the physical market is screaming shortage and the paper market is screaming cheap, the price mechanism is malfunctioning. Price is supposed to coordinate supply and demand. If demand rises, price rises to ration the available supply. and incentivize more production. If the price falls while shortage worsens, it means price is no longer discovery. It has become camouflage. That's what a broken system looks like. The screen tells you one story, but the real world tells you the opposite. The screen says silver is cheap and unwanted. The real world says refineries are booked, delivery is delayed, and buyers are paying up. Those two realities cannot coexist indefinitely. The gap is tension. Tension builds until something snaps. And snapping doesn't mean a gentle adjustment. When a market goes from paper claims to physical priority, the change is violent. It doesn't move $1 at a time. It revalues overnight. It reprices through gaps. It forces contracts into cash settlement. It creates the kind of chaos where you wake up to a new number and everyone pretends it was always supposed to be that way. Think about the endgame options, because this is where the chessboard has fewer squares than people admit. If the paper exchange wants to restore credibility, it has two roads. One, it allows the paper price to rise until it's high enough to attract real supply and close the gap with the physical market. That means the quote you see in New York has to jump dramatically to match where the metal is actually being bid. This path is painful for shorts and banks, but it keeps the market functioning because it aligns the screen with reality. Two, it refuses to reprice and keeps trying to cap the quote through rule changes, margin hikes, and narrative warfare. This path is painful in a different way. It risks draining the remaining inventory and forcing the exchange into some form of we cannot deliver moment. The moment a major pricing venue is suspected of being unable to meet delivery obligations, the price doesn't simply go up. The price becomes no offer. It becomes whatever someone is willing to accept in the currency they trust, and it becomes wildly discontinuous. This is why I keep bringing you back to physics. You can twist numbers on a screen, but you cannot print metal atoms. You can change trading rules, but you cannot negotiate with scarcity. You can frighten speculators, but you cannot margin call a solar factory. Eventually, the physical constraint wins. It always does. That's reality. Now, let's strip away the dramatic language and focus on the clean, cold mechanics that make this feel inevitable. A 20% premium means arbitrage flows. Arbitrage flows mean inventory relocation. Inventory relocation means the center of pricing gravity shifts. When the center shifts, the old reference price loses authority. When authority is lost, the reserve currency's influence weakens further, because the reserve currency's power is intertwined with its role in pricing commodities. When the dollar weakens, commodities don't just rise, they reveal the weakness. And once the weakness is visible, more capital moves, which weakens the dollar further. Feedback loops feed themselves. That's why you're seeing desperation tools, margin hikes, narrative management, sudden rule adjustments, and an obsession with keeping a headline price low while the real market moves elsewhere. Low prices feel good politically. They mask inflation. They make consumers believe the currency still works. But low prices in a paper market can be a poison pill when the physical market is bidding higher, because they encourage exactly the wrong behavior, exporting your inventory at a discount. Imagine running a grocery store in a hurricane. Supplies are running out, demand is rising, and your shelves are thinning. The rational move is to raise prices, so you ration stock and signal suppliers to bring more. But the mayor stands outside and orders you to lower prices, so people don't panic. You obey. People rush in. The shelves empty faster. Your store is out of food by nightfall. The public cheers the low prices right up until the moment there is nothing left to buy. That is the logic of price suppression in a scarcity event. So when you hear someone celebrate that silver is down, ask yourself, down relative to what? Down in paper terms? Down in a currency that is weakening? Down on an exchange that can change margin rules by decree? The question that matters is not the number on the screen. The question is, can you take delivery at that number? Can you replace your inventory at that number? Can a manufacturer source at that number? If the answer is no, then the number is a fiction. And fiction is dangerous when it meets scarcity, because fiction invites overconsumption. Fiction invites hoarding by those who understand the gap. Fiction incentivizes the strongest hands to vacuum supply, while the crowd is told there's nothing to see. Now, what does an ordinary person do with this? I'm not here to tell you to panic. Panic is what weak hands do. I'm here to tell you to stop confusing comfort with safety. Comfort is a story. Safety is a structure. If your entire financial life is denominated in a currency that is losing purchasing power, and if the system that sets the price of hard assets is showing signs of strain, then your risk is not just market volatility. Your risk is denominational. Your risk is that the unit you're using to measure your wealth is changing faster than you are adapting. You don't have to become a prepper to understand this. You just have to understand incentives. When institutions defend optics instead of inventory, they are telling you something. When spreads blow out and stay out, they are telling you something. When physical buyers pay big premiums while paper quotes get smashed, they are telling you something. When refiners speak in terms of backlog instead of abundance, they are telling you something. Here's the uncomfortable truth. In a real scarcity environment, the cheapest price is often the least obtainable, and the most liquid market can become illiquid the fastest if it's built on promises instead of stock. Liquidity is not a permanent feature. Liquidity is confidence. Confidence evaporates when delivery becomes questionable. So, if you're watching this from the West, do not let volatility hypnotize you. Do not let the red candles on a screen become your reality. A chart can be bullied. A warehouse cannot. When you see margin hikes intended to scare longs, interpret it correctly. It is not the roar of strength. It is the cough of weakness. It is a system admitting it needs forced selling to create the illusion of control. And do not let propaganda do your thinking for you. If you suddenly see a wave of content telling you silver is stupid, ask why that wave arrived now, not 5 years ago, not 10. Ask who benefits from you staying in paper and not touching physical. Ask why the argument is always framed as you can't sell it, instead of why are premiums rising if nobody wants it. Follow the incentives. The end of this story will not be subtle. The gap between two realities cannot remain forever. Either the paper price rises toward the physical bid, or the paper market loses credibility and the physical market becomes the reference. Either way, the direction of the reconciliation is upward in nominal terms, because the physical side is already paying more and because the currency denominator is already under pressure. And the moment the world stops treating the paper, quote, as authoritative, you will see a repricing that feels like an overnight event, even though it was built by years of gradual drift. People will call it unexpected. It won't be. It will be the release of tension that was visible the entire time to anyone watching spreads, inventory, delivery rules, and currency trends. Let me end where we began, with that dollar bill. That bill is a promise. It is not a thing. Silver is a thing. In calm times, the system convinces you that promises are as good as things. In stress times, the world remembers the difference. If you want to survive a period where the map is being redrawn, you don't need to predict every headline. You need to respect physics. Physics says scarce conductive metal used by modern civilization has value that cannot be permanently suppressed by paper contracts. Physics says supply chains obey price signals, and a huge premium will drain inventory. Physics says you can print claims faster than you can mine atoms, and eventually claims get repriced against atoms. So treat this moment as a warning flare, not because someone yelled collapse, but because the mechanics are visible: dislocated prices, a weakening denominator, defensive rule changes, and physical bottlenecks. That combination is not normal. That combination is stress. That combination is the kind of pressure that precedes a regime change. Hold on to your awareness like it's an asset. Question the numbers that feel too convenient. Watch the spreads, watch delivery terms, watch inventories, watch currencies. And remember that when a system spends more energy on controlling perception than on delivering reality, reality is already winning.